Please do not short the market here. Don't fall for the perfectly set bear trap from Friday's session. And technically, I'm a believer the market could move lower, but the trade location here is incredibly dangerous for large new money shorts, and I'll show you exactly why in today's episode of the Weekly Watchlist. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we're certainly looking at a solid red-bodied bar with just a little bit of an upper wick on top. It's certainly negligible in relationship to the size of the candle body itself. If anything, a little bit of buying pressure was clearly erased by a whole lot of selling pressure. The bears did a great job of closing extremely weak at the bottom of the overall range, so a big check mark goes to our sellers. If we think about location, we certainly have on the bar-to-bar count a higher high, but also a far more substantial lower low. So classically called a bearish engulfing pattern, that of course is bearish from a location perspective. 2 for 2 goes to our sellers, and this really should not come as much of a surprise here. The main thesis we've been working with over the past couple of weeks is to set some sort of weekly lower high. And just as a reminder, is this a logical place for the lower high to be set? I would make the argument absolutely. It's the retest of the double top neckline, right? So very, very logical place for that lower high. And we find ourselves back down at the equal low. So the downtrend remains intact here. And there's really two outcomes to either continue this trend or reverse the trend, right? We can either produce some sort of big lower low, or we can produce another lower high and look for another attempt at the equal low and then some sort of subsequent breakdown. The only thing that neutralizes the trend is an equal high way up here, closer to 438. We'll see that on the daily chart in just a moment. Now, if we're thinking about the outcome where we break to a new lower low, why is it not ideal for a new money short? Because technically, all the signs kind of point to sellers being in control here, but from a structural point of view, notice this level right here, and we've talked a lot about this level on the monthly looks over the past, 3 or 4 months, whenever a monthly bar closes out, right? There's the opportunity for a monthly higher low on the retest of this level at 416.75. We also know that it's our weekly 50 SMA at this point in time. That's the blue moving average on your screen, always a 50 SMA. So if we scrunch this chart out a little bit, here's the monthly inverted head and shoulders pattern, right? This is the neckline breakout area. And if we're retesting that for a possible higher low, the monthly chart remains constructive and in an uptrend if we find buyers around this area. So don't get me wrong, there is a little ways for the market to continue to fall in the downward direction, and making a lower low would keep the downtrend sequence in place, but I would not be an aggressive new money short until we firmly break that level and find some sort of lower high sequence underneath, noting that that would be a massive failure of this as a range breakout, right? If this is a failed breakout, we know that the target is always the bottom end of the range. I mean, we're talking about 375, and I don't want to be a doom and gloomer, and I certainly am not of the belief that this happens this week, but in the larger sequence where, yes, this is a fake break, I mean, that's a realistic target over the next couple of months, right? So that's the really bearish situation. But once again, it only is available from a risk reward perspective once we're underneath this level. The risk reward as a new money short here is absolutely awful. Another reason as to why it's not ideal location for a new money short is, remember that from a double top measured move perspective, you usually look for the range to double, and lo and behold, that kind of brings you right into this retest area here, the 50 SMA that we were just looking at. We also know that if we throw on the anchored VWAPs on the weekly time frame, that again, it makes very logical sense that these have rejected the top of the pivot here, the AI mania, and we finally do have a decent close underneath this anchored VWAP from here. It's the first time we've firmly closed underneath. So once again, I'm not arguing that the market can't move lower, but I am arguing that the risk reward at this particular location here on the higher time frame is not ideal. I mean, think about these anchored VWAPs slowly, like a slug, going to be creeping up, providing confluence around this zone. Do you want to be a new money short at support, or would you prefer to see another lower high, equal low reattempt, and then a break? Or would you prefer to be a short underneath after we're confirming a lower high? I don't know about you, but I would prefer not to be a new money short here. I would prefer to wait for this sort of look over here from a risk reward perspective. Remember, it's all about trade location. It's all about risk reward. And again, this does not speak to this level needs to hold as support. It doesn't need to do anything, but from a location point of view, I think it's dangerous chasing the short at this particular location. Why else? If we throw on some Fibonacci's here, what you'll notice is quite interesting. Again, there's supporting evidence that would suggest there's a little ways to go lower because we've finally broken down underneath this 61.8 with a little bit more strength, right? Same place as this anchored VWAP. It's the magical fib zone we've been calling it, right? If you do something like this, you get confluence with a 38.2. If you come in from here up to here, you get confluence with a 61.8. So we're firmly underneath all of those Fibonacci's, which again would be a bearish indication. But if you take out a fib from the October low to the pivot high, and all these are reasonable places to attach a Fibonacci to, notice that the 38.2, I mean, not for nothing, we're off by 2 cents. Did we not say 416.75? We have 73 here on the Fibonacci from October low to the most recent pivot high. So if this is technically going to be healthy bull flag consolidation, this is where you want to find buyers. So once again, location-wise, I think new money shorts are not ideal at this point in time. One last thing for you, and it just completely agrees with the thesis that we're outlining here, is that we've firmly pushed away from the highest volume node, the point of control on the volume profile from this perspective, and we've firmly broken down underneath this last and final volume shelf. We're finding ourselves in the low volume void. And where's the next high volume node underneath? It's at 416.75. So once again, a little ways to go lower, absolutely. But do you want to be a new money short at this massive area of support? Probably not yet. On the daily time frame chart, let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. Overall, this is a bearish expected move with a lower high being suggested at 430.65 if we are contained, or a lower low being suggested at 411.77 if we are contained. One thing that I do want to point out here is last week's expected move was roughly $9. This week's expected move has grown by about 50 cents. $9.45 is the expected move. And we know that for the most part, we are in a daily downtrend now. We were looking at the possibility of a daily uptrend being found if we could hold the higher low here. Certainly not the case. So instead, the trend count now goes as follows: lows, lower lows, highs, and we certainly just don't have a lower high yet. So in a picture perfect world, the lower high wants to be set underneath 430, this area of our prior higher low. And also this was a range that we can see on the hourly chart in just a moment. This is an overhead range, would also be rejecting as overhead supply. So the ideal lower high is below 430, but you could technically make the argument that yes, you could still find a lower high even if you turn around here up against something like 433.65. Now, if the weekly chart is going to neutralize the trend, if this is going to hold as an equal low on the weekly, I just want to put your mindset to start thinking about some sort of weekly double bottom, a very, very much so a stretch of the imagination, right? But the weekly chart will not change trend unless something like this technically happens. So even if you want to use it as a bearish data point and call it a stretch of the imagination, you could just imagine how difficult it would be to change the weekly trend, imagining that this needs to be the case if you're going to get that reversal. So not really going to happen there. In terms of pattern and what's going on from this perspective, as a balance range, typically when we break balances, we look for a doubling of the range, and lo and behold, we've doubled, if not a little bit more, moving back down to these equal lows. This is technically a 100% retracement, and we always say you never want to be short on a 100% retracement, or long in the case of a V-shaped recovery like this, right? Reason being is that oftentimes it's very difficult to travel immediately through this area of support. Instead, the market's a bit extended to get here in the first place. You look for a lower high to be set, and if that lower high is set and we get an equal low reattempt in short proximity of time here, that's the better entry for the downside. So your stronger shorts want to see a lower high set first on the daily time frame chart. If you're looking for a quicker snapback in the upward direction, continuing to extend this here actually does a couple of really interesting things. Not only does it push it further than a 100% retracement, but it repairs the extremely poor structure from the lows back here. Remember, this does not go away. We have unfinished business at these lows. They're too precise, and there's an overnight session low that was made in here that would indicate this is the improper end of the auction. So moving through it first not only extends it from a retracement perspective, but it also repairs the structure. Some sort of snapback after that would be more than likely. So a new money short down here still does not make sense, even though we just talked about on the weekly looking for a stronger move towards 416.75. You'll also notice that we've closed underneath our daily 200 SMA, which is a bearish indication. We have not interacted with the 200 SMA in quite some time. It's been a long time since we've tested that 200. Let's take a look at our trend line set, because I do just want to point out that once again, everything should be making sense here. No surprises. We are underneath and we've rejected the retest of the neckline of the head and shoulders. And if the head and shoulders measured move is going to be correct, technically that would indicate we need to move back down to the midpoint of our godforsaken range back down here around 411. Now, personally, I'd prefer to see this area, that 416.75, really act as support first and not travel back down into this range. That's my preference. We will see how the market ultimately unfolds. This would be something that I would prefer to see for a stronger, again, monthly higher low to be found. So everything should start to be coming together here on all the different timeframes that we've explored so far, that yes, couldn't repair these lows. We can look for a little bit of an extension, but we are technically trying to find a monthly higher low, and chasing the move after 3 aggressive down days of this nature, probably not ideal, again, from a risk-reward entry perspective. Let's take a look at some, not Fibonacci's, but rather the anchored view apps, just to illustrate that we are moving away from the AI mania band, right? None of this should really come as a surprise as well. A lot of the weekly view apps make a lot of similar sense, right? And into this band of support. So rejecting this, of course, is bearish, but if we can turn around somewhere in this band, then not all hope is lost. If we start trading in this area down here underneath the purple dotted line, much larger issue for our S&P market. We're probably talking about that deeper retracement to 375 that we were looking at on the weekly time frame. Here's the hourly chart. What else can we learn about the price action here? For the most part, everything was fairly straightforward on the breakdown. I mean, we have an hourly downtrend, that is for darn sure, with highs, lows, lower lows and lower lows. If anything, we just got some volatility here when Powell was speaking on Thursday's session, and that volatility produced a lower high at a very logical place, right? It was the retest of the prior day's low. Also, this area from back here, you can see where there's a little bit of selling pressure keeping us pinned at the lows. Remember that Monday and Tuesday were really a gift to the buyers, and those buyers had failed to produce an hourly higher low or consolidation above 433.65 with that Wednesday breakdown. So Powell's lower high makes a lot of sense. Aggressive breakdown comes in, and we even found an intraday lower high underneath 425 into the Friday session. So all things considered, the bears are totally in the driver's seat here. I'm not really sure how anyone would make the argument that we have more of a bullish rotation going on just yet. Let's take a look at some intraday anchored view apps, and what you'll notice here is we've adjusted a couple of them, no longer anchoring to the FOMC, but for the most part here, and the tippity top of the most recent move. Notice that all of your confluence is right at 430. Did we not just discuss on the daily chart how even if we do get a counter trend move, you can find a daily lower high beneath 430? Would make a lot of sense from this anchored view app perspective as well. We will take a look at the Fibonacci's just coming in from the low of the Friday. What is that now? 3 weeks ago? Whatever it is. And if we bring this out, what you'll notice, and recall, we did have a level at 427.50. We're underneath the 61.8, right? Technically speaking, the market just blasted right through this level. There's no reason to have anything there anymore. It's thin structure now. But for the most part, staying underneath that 61.8 also keeps the bears in control. If we bring one out from the FOMC to the bottom of the overall move, lo and behold, this one should not be a surprise. 38.2 is still your 430 area, right? So still building the case that a daily lower high certainly looks good as long as we're underneath that 430. So what do we have for actual paths into this upcoming week's worth of trade? Let's break it down one by one. If you're a bear, you want to see hourly downtrend continuation. You can get that in two ways. Either just continuation straight lower underneath 420.50, which is the extremely poor structure back here. So straight continuation through that, you're looking for lower highs and trading into that 416.75. If that doesn't really suit your trading style, then you're looking for lower highs here under 425, trading for the equal low, and then a breakdown in short proximity of time. That's the most bearish outcome here and what the bears ideally want to see. If you're a counter trend bull, what you're looking for, again, notice that I said counter trend bull because clearly we're in a downtrend across the board now. If you're a counter trend bull, you want some sort of continuation into 416.75 to extend, like we were talking about on the daily time frame chart, and you want to look for any 5 or 15 minute double bottoms intraday here, any sort of inverted head and shoulders down here, then you're looking to play that back long in the upward direction. The issue for bulls is that you have to immediately contend with the retest of 420.50. If we start to get price acceptance over 420.50, a higher low here becomes really attractive for a larger counter trend move to still set some sort of daily lower high. And as we described, that could be anywhere underneath 430. If we don't continue lower first, the game plan for the buyers is to look for consolidation down here and a little bit of a short squeeze. I say that with an asterisk next to it. A little bit of a short squeeze only on a higher low over 425. You can trade for this range here, boom, to this. The reason I would put an asterisk is because, again, still very, very clear opportunity for a daily lower high, and still that leaves this structure untested, unrepaired. Now that we would have another subsequent test around this area, it would weaken it that much more. It would speak to the lack of the proper end of the auction down here at 420.50, begging for the repair of that level over time. So I don't really think it's enough of a squeeze, so to speak, that would really kick off a stronger reversal in the upward direction. With all of those paths outlined, let's take a look at the internals. Market internals are always supporting evidence exhibit A. If you're not familiar with the screen, check out the video tutorial in the top right-hand corner. For the most part, very simple. Let's not overcomplicate it this week. Is there a bullish or a bearish edge here? I think it's incredibly clear. We have a bearish edge from the net volume flows, really substantial, and really substantial on the Friday breakdown. Definitely more bearish price acceptance in the advanced decliner underneath the zero line here, and the cumulative builds from the tick are aggressive to the downside. I would have expected, honestly, a little bit worse on the Friday session, but nonetheless, it might speak to, once again, put the pieces of the puzzle together, not wanting to be a new money short at the bottom of this overall move. Being a short on the lower low is usually incredibly difficult, and you can see that there wasn't much conviction across the exchange for continuation lower at the end of Friday's session. Usually, a substantial build is somewhere around negative 5,000, like what we had on the Wednesday session. So I think the breakdown has, for the most part, unfolded. A little bit of continuation gets us to the monthly higher low, and the internals will be a big tell early in the week if we start to see buyers showing up for the monthly support. Market profile is always exhibit B. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Once again, let's keep it fairly simple to start. What do we see with the value area and point of control? Here's the Monday session. Here's Tuesday, of course, Wednesday, Thursday, and Friday, the worst of them all, breaking away clean to the downside, and the point of control is not even overlapping with the previous day's session. So Friday, the most bearish sort of nail in the coffin, if you will. Something to start thinking about, though, as we migrate towards the monthly higher low structural support is where does the value area build out in the individual session? Something to point out here is that when the value area is high in an overall profile, it would just suggest that this is where the most positions are technically held from. And you could use an anchored view app intraday as well to help navigate and get this information. But nonetheless, if this is where the average position is held from and we open underneath, longs there are underwater. If on the individual sessions we start to see the value area migrate lower with price, technically it's showing bearish acceptance. But if we start to move above it, the average position from the buy side is going to be held at great location. So if you see that as we approach that monthly support, it's not an immediate indication that, okay, it's time to go long. It's just one more data point that we can stack up saying, okay, buyers have achieved an ideal entry point. The other thing that I want to point out here before we move along to some other supporting market evidence is really looking and examining the prior low, right? We had a poor low here, a poor low here. It was repaired technically with this move from the Friday squeeze of 3 weeks ago now, but something that we didn't cover in the past was that we put in a low in the after hours session, and that's really an unsecure low. Lows want to be found from an auction theory perspective, at least, when the most volume is flowing, and that's a regular trading hours session. So because this low is unsecure and it's not technically the proper end of the auction, once again, it would suggest that we need to migrate lower first to repair that before making a more substantial move, structurally sound move in the upward direction. And this works both ways, by the way. What you'll notice is back here, we do have an overnight high at the very top of the overall move. Once again, marking that this, in theory, should not be the proper end of a major pivot point in the market. Doesn't mean that we're just going to be like, okay, we have to come back up here, we have to come back down there, but it's, again, one data point to include in your analysis. Changing gears to the QQQ weekly time frame chart, what do we see here from a candle structure and location perspective? Extremely similar to our S&P with a couple of very nuanced differences. So still a solid red-bodied bar, a little bit of an upper wick, once again, not really substantial in relationship to the size of the candle body. body. If anything, buying pressure clearly wiped away by all of the selling pressure. Sellers did a great job of closing extremely weak at the bottom of the range. So once again, structurally, sellers in the driver's seat. Location-wise, this is one of those nuances, certainly a bar-to-bar lower high, but also a substantial lower low. And this is really important to understand because first and foremost, the close of the bar at this lower low and the lower high, lower low combination keeps us in a weekly downtrend, not only rejecting off of a logical resistance trend line here, but remember also that we had a balance range that looked something like this on the weekly. If this was truly going to only be a look below and fail, and if we were truly going to rotate to the top of the range, any pullbacks needed to find a higher low above 357. And we talked about that level in the Wednesday update. Clearly, we have closed underneath on the weekly time frame. So at this point, the relative strength over here in the NASDAQ side of the market is seemingly starting to dissipate just a little bit. Now, we find ourselves right back down at the equal low. So if we do get continuation, just like the S&P, we are looking for the downtrend to continue. It's after a lower high. So everything's good from a trend perspective. But the difference, once again, is that if you look left, we do not have our major monthly structure here for a retest. Remember that the AI Mania breakout in the QQQ was far more substantial than what we got over in the S&P. So your equivalent of 316.75 or 416.75, excuse me, over on the S&Ps is way down here around like 321 on your QQQ. You have all of this thin structure to technically retrace if you start to get a stronger breakdown underneath these lows, which are closer to 355. We'll see those on the daily chart in just a second here. So don't forget, we're in a downtrend. We're rejecting key resistance off of the resistance trend line, and we have closed underneath the balance. So the relative strength is dissipating here. Again, even if you don't want to use trend lines, like if you're more of a fan of horizontal levels, where was another place we were talking about ideal lower highs? It was on the retest of the double inside bar range, the bottom of it, and that's exactly where we started to reject here on the weekly time frame. So everything's making sense that this is not the beauty that it once used to be. If we take a look at the anchored VWAPs, again, you'll see a little bit of relative strength being above this anchored VWAP, nowhere close to this down here. But if anything, it suggests that if this is going to play catch up on a structural basis to the S&P, there's a lot further to fall here in the NASDAQ. Now, once again, we're not making the case that we go all the way to this level in this upcoming week's worth of trade, but it's something to be aware of as and if we continue the breakdown into the next little bit here. Let's take a look at the magic Fibonacci zone, if you will. It's coming from the all-time high to the October low, and of course from this to this, and there's our confluence, and we could do the same thing with the AI Mania as well. Let's just do it for the sake of being consistent. Notice that this is the slight continuation. So this week, if the S&P moves lower and the NASDAQ moves lower, if the S&P finds support at the monthly higher low area, you might look for the NASDAQ to slow down a little bit here closer to the 348-ish zone. If the NASDAQ really slices through this zone, then what you would say is, okay, I'm not going to be as much of a believer in the S&P stopping at 416.75. So that's how I would juxtapose the two markets as we move into the coming weeks worth of trade. If one starts to hold, if the S&P starts holding, then you might look for this to start to hold. If this just blows right through, look out below. Use a little bit more caution for trying to buy any counter trend moves in the S&P. And as a matter of fact, you might actually start to reconsider, maybe we do take a little bit more of an aggressive short if the structure permits and the QQQ is breaking down through this key level on the weekly. Once again, that number is 348 on your QQQ weekly. If we come in from the October low to the most recent pivot high, where's your 38.2? It's about $10 lower. We're talking about 337 if we just want to use round numbers at your 38.2, furthering the suggestion of some downside. You also get prior structure from back here, and the monthly level, the retest level, as we talked about, 321. So it's definitely some more downside to the QQQ if this starts to fail the 348 level that we were just discussing in terms of slight confluence of support there. Let's take a look at the volume profile. Clearly breaking away from this area, but not firmly underneath it yet. So breaking away from the highest volume node, all of this should make sense, but we're not in the low volume void yet. If we do start to migrate lower, lo and behold, you get the high volume node closer to that 337. We just described that from a 38.2 perspective. Then even further than that, like if you're truly going to rotate through the entire low volume void, lo and behold, 321. Daily time frame chart, QQQ. Here's the expected move. The upper bound is at 363.90. The lower bound is at 345.32. And clearly that's a suggestion of a lower high or a lower low, definitively bearish from an expected move perspective. The daily trend is also now down with highs. Lower highs were found here intraday. We'll show you that on the Powell volatility in just a moment. And if we had lows, we certainly now have a lower low. From a pattern perspective, we have failed to stay. The buyers have failed to keep price above the prior balance area at the bottom. And once again, on the weekly time frame chart, if this was truly only going to be look below and fail, we needed to find a higher low over 357, slice right through it on Friday like a hot knife through butter. So going forward, what do the bears want to see on the daily time frame chart? Any lower highs that are set underneath this range high at 361.50 would be ideal. Could we technically still get a lower high up here at 364.25? The answer is absolutely, and it would be a retest of the bottom of this little balance up towards the top. There was a 3-day range there. Bearish bar on the Friday of 2 weeks ago. Then we have Monday, Tuesday in here. 3-bar range that started to break down truly on the Wednesday session. So the bottom of that, once again, 364.25 is technically still okay for a lower high, and that's perfect confluence with the upper bound of this week's expected move. To the downside, if we do get that straight follow through underneath the key weekly support, 352 is that level. Your next downside target is a lower low at 346.85. And once again, start thinking about what that means from a anchored view app and Fibonacci perspective that we were just exploring at 348, right? Just off by a little bit here. So a little bit of continuation structurally would make sense around that zone as well. We're kind of splitting hairs, call it 347. We're only off by $1 on a weekly chart. It's really not all that big of a deal. Let's move down though to a trend line perspective first, and then we'll go to the hourly. The hourly is, of course, where our day time frame operators will be more interested in the nuances of the levels. But notice, again, great rejection of, not only this, as we know, was like a daily double top. There's your rejection of that level, resistance trend line, back test of the major support trend line from the October low channel. So all of this is making sense. We've failed our daily 50 SMA. We're now firmly back down underneath that. The daily 200 SMA is quite a ways away. Once again, speaking to that slight relative strength on the NASDAQ side of things. We're talking about 337, once again, about 10 points lower from that magic zone that we were just discussing on the weekly chart anyhow. So breaking this down, we're starting to see how all of this, again, the picture comes together quite nicely for all of these levels to act as slight confluence. Just to give you an idea of where the lower bound of the trend channel will be this week, we're talking about roughly 344, 343 as an area. Let's take a look at our anchored view apps just again to get a sense of where that band is. How are we doing from a relative strength, relative weakness perspective? You'll notice rejecting the AI mania and not yet though inside of the lower band. So once again, it makes the argument that there's a little bit of strength here still, suggesting that it's not all is lost, so to speak, over on the NASDAQ. Sure, we're underneath the immediate band, but there's still a lot of reason to believe there's some support in this zone. Things will certainly become concerning. Lo and behold, again, not for nothing, look at the confluence out of this market. It's just beautiful. If this is the monthly retest area at 320, it's the bottom band of the anchored view app sort of fan, if you will. If we start trading down here, we have much larger issues to be dealing with in the market. Clearly, that's quite a ways away. It's not an immediate threat into this coming week's worth of trade, but something to start thinking about down the line if a stronger breakdown continues to unfold here. Here we go on the hourly time frame chart. Again, clearly in an hourly downtrend, just like the S&P's highs, lower highs. There's your Jerome Powell volatility for the lower high intraday that we were just describing, and a clear rejection of your daily 50 SMA. It's also a rejection of the bottom of the newer balance. That's that 3-day range we were just describing. We failed to close an hourly bar over that level at 364.25. So once again, reinforcing the idea that the daily chart can produce a lower high beneath that level. Ideally, it's right here though, and we do not exceed 361.50. Let's take a look at the anchored view apps intraday. And what we'll notice from this perspective is that, once again, beautiful confluence as these start to rain down, if you will, on 361.50. That's your ideal lower high. A big reason to believe you could still set some sort of lower high there on the hourly time frame chart. Lastly, before we talk about pathing explicitly, let's bring out the Fibonacci's from the low here. Obviously, it's more than a 100% retracement, but just reinforcing the idea that the 61.8 is, once again, 361.50. If we bring them out from the FOMC breakdown, which is way back, actually, you know what? Let's go from here. Let's go from here to here just to see. Not for nothing. Obviously, obviously we're splitting hairs by, using the difference of that, but nonetheless, 38.2 still stacked up there. If this is truly bearish consolidation, you just stay underneath, once again, 361.50. Now let's just do this one for the fun of it back to the FOMC, just to see like kind of where we maybe are getting confluence. Yeah, look at that. You're 61.8. I understand that we were obviously higher here, but if there is a stronger rally, once again, reinforcing the idea that 364.25 can act as a reasonable place to keep the bears in control. So in terms of pathing, bears for hourly downtrend continuation want straight up continuation to the 352 level, straight down here. Any sort of 5-minute, 15-minute double bottoms. Lower high is ideal off of 357, but room for a counter trend all the way up to 361.50, right? So that's what the bears want to see. If we move straight through 352, we have 346.85. That would be difficult to chase. I would honestly say that's difficult to chase on a straight shot lower here. You need a very tight intraday lower high for stop, entry, and then target, right? Maybe that gives you some sort of 3-to-1, 2.5-to-1, something more realistic intraday. But a straight shot lower, if we just do this and now we're trading down here, you've got to pick off something intraday to get you to that 346.85. If we do see a rally first, again, bears are looking for a lower high up against this major area of confluence, 361.50. For a counter trend bull to get involved, once again, I'm going to emphasize counter trend bull, you're looking for a recapture of 361.50 with a higher low. Something that does this certainly starts to become a little bit more constructive, right? Because now we're back outside of this original range. You really start to feel that if we can get a higher low above. Remember that you have to do battle here first to poke through the level and not reject for a lower high in the first place. So seemingly a little bit more unlikely. The bulls, in the opposite sense, you can look for, again, as we just described a brief moment ago, intraday double bottom here. You can still trade for the counter trend, but once again, you instantly have to start contending with 357. If you get a higher low pullback that does something like this, if you're coming from here off of this type of structure, this could also be a bullish counter trend entry only, above with a higher low, 357. Let's take a look at the internals. NASDAQ internals very similar to our S&P, very substantial outflows from a volume perspective. The bears are in control here from the advanced decliner into the end of this week, and the cumulative builds are actually a bit more aggressive on the Thursday and Friday session, speaking to the idea that, again, if that relative strength is waning in the NASDAQ, there's some room to fall here if the sellers are going to continue to press the gas pedal in the downward direction. Let's take a look at the market profile for our NQ futures, and it's the same concept where here's value area on Monday, Tuesday, Wednesday, Thursday, and Friday clearly break away to the downside with a point of control not even overlapping with that Thursday range. So all similar comments from that perspective, no deficiencies or thin structures to point out from that point of view. One thing I do want to make note of, though, is that the lowest low in this overall sequence was made in a regular trading hours session. So we do not have that structural deficiency at the very bottom of the overall range like what we do in the S&P. So that does not need repair, and if there is a firmer breakdown of that level, I would certainly look at that as not just being a sweep of stops, but rather a more substantial structural breakdown. Now on over to the IWM Russell 2000 and the small caps, kicking things off on the weekly time frame chart. What do we see from a candle structure and location perspective? Pretty different from the S&P and the NASDAQ, with an upper wick almost the same size as the candle body, just indicating that all of the buying pressure that was exerted was not only reversed for a minor move under the opening print, but the range more than doubled underneath the opening print. So a huge failure from the buyers is the indication of that huge upper wick on the weekly bar. We have closed underneath major weekly support in here, and the next major weekly support, the reason I'm calling this major is because, as we'll see in just a moment, underneath 164, there's not much until about 10 points lower in small caps. And as we know, if we just zoom this out to something like, I don't know, let's go over here and let's change this to like a 5-year chart. This is a massive monthly or weekly bear flag, whatever you want to call it. And notice that we're now trading underneath the pre-sickness highs, right? There they are. We broke down firmly in last week's worth of trade to get underneath that key zone. If we throw on the not Fibonacci's, but the anchored VWAPs first on the IWM weekly, all-time high, October low, just not even close. It's not even worth talking about from that perspective. There's no reason to even put a Fibonacci on this range. Obviously, we're trading at the lows of the overall range. There's no reason to put a Fibonacci on this range. Obviously, we're trading at the bottom of that overall range. The only thing that might be worth taking a look at from a Fib perspective is from here to here, and just notice that we're in the midpoint of no man's land, which is between the 38.2 and the 61.8. So from a pattern perspective, anchored VWAP perspective, Fibonacci perspective, small caps are looking fairly dismal here if we start to break down underneath this major weekly inflection point. Let's take a look at the high volume nodes and see what this can tell us about the market. And again, we need to do ourselves a little bit of a justice here and bring out like 5 years worth of time. And again, maybe there's some support around this 155, 152 that we were just seeing from a structural perspective. That would be the bottom of this weekly range before the breakout here. But again, you're talking about a massive move in small caps to continue just this outright, Armageddon style panic sell where nobody wants anything to do with small caps. And it's pretty straightforward that Jerome Powell was very clear that small cap zombie companies, they're not going to exist for very long considering what's going on with interest rates. So the fundamental narrative is playing very nicely, I would say, with the overall technical picture here. Let's take a look at the daily time frame chart. This stuff is going to be very brief on the IWM. There's not much to read into. If this was a balance range, we certainly broke it down on the Friday session. The expected move here on the daily time frame chart is bearish, obviously just suggesting a lower high or an extreme lower low. There's literally no structure in here until we get closer to 164, 162. That's technically a gap. Then we have a further gap. That's what we were just looking at on the weekly, closer to 155. So that's really all you have structurally underneath us that's going to provide any sort of footing. You might find something arbitrary in here, but there's nothing that we can look at in advance and say, okay, this is making sense structurally. So overall, nothing good to say about small caps. Clearly a case to be made for a lower high underneath 169, even if we do move to the upper bound of the expected move. Lower high to be made at 170, 185 in there. Let's take a look at the hourly time frame chart. And again, there's really not much to rehash. Clearly in an hourly downtrend, if you're going to think about a stronger reversal for the IWM, then it really would have required this turning into a double bottom and getting price acceptance out here. I mean, look at where we're trading. The chart really speaks for itself. This is the massive failure from the buyers that really produces the upper wick on the weekly time frame chart. And again, we've more than doubled that range in the downward direction since breaking down through the opening print of the week, which was back here. So bears in total control, I would use 169 as a major pivot. Let's take a brief glance at what's going on with the intraday anchored VWAPs. And this is making fairly good sense. Any lower high attempts here are just, ideal. Anything that does rotate higher, you have the thick band just barreling down on 171.85, clearly again offering an opportunity for some sort of lower high. And just straight up continuation, we already talked about the lack of structure underneath us. So there's really nothing impressive to say here. I would say 169 is your major pivot. You could look for the counter trend if we get some sort of if this is a range overhead and this turns into look below and fail, maybe a higher low kicks off a counter trend, but I certainly would not overstay my welcome in small caps until there's something far more substantial and constructive here on a higher time frame chart. Let's take a look at the market internals for the Russell side of things. Again, substantial outflows individual days on the Wednesday, Thursday, Friday. Bears in control from the advanced decline line perspective. Terrible on Wednesday. Thursday is pretty bad as well. Friday actually closes right at the zero line from a cumulative tick perspective. So again, a little bit of a snapback. Is that reasonable? I would say absolutely, considering the sort of extension here to the downside coming from being extended through the upper bound, straight shot lower. There really was no major counter trend move in there. It was just, sell. Nobody wants anything to do with small caps at this point in time, and that continues to be the case. Let's take a look at the market profile for the RTY futures. It's again the same story. Well, you'll notice this is actually Tuesday's session, so value did migrate higher. Nothing but a short squeeze though. This is not new money buyers, and we always know that. Look at the volume commitment in here. Extremely emotional buying to squeeze out the shorts. We do have an unrepaired poor high at the very tippity top. Is it likely that we trade there this week? I would tend to think not, given everything that we've just explored thus far. And other than that, value continued to progress lower. Here it is Tuesday, Wednesday, Thursday, and Friday. Sort of more centralized on the Friday session, not slammed all the way towards the bottom of that individual day's session. So we'll continue to monitor this, but again, bears seemingly still in full control of small caps. So let's dive a little bit deeper and take a look behind the curtain, so to speak, at some further supporting evidence. Here's the percent change on the week for our S&P sectors. Notice what led the pack up here. It's the XLP consumer staples up 0.12% on the week. The XLE energy sector follows up 0.1%. At the bottom of the barrel, it's the extremely rate sensitive real estate sector down 5.21%, followed by consumer discretionary, really beat up by Tesla earnings. So if we just think about this spread in terms of who's leading, who's losing, at the top, it is a D for defensive sector, and energy, which is incredibly lightweight, and in the current context of the global environment, I would say that energy is also a defensive play, considering what's going on in the Middle East. In terms of at the bottom of the barrel, real estate is incredibly lightweight sector, so that's not really all that important. And again, it's not really that surprising considering what's going on with rates, but XLY is a fairly heavyweight risk-on sector that's also down very substantially, down 5.09%. That's not nothing. Let's take a look at these structural charts and evaluate what's going on from a trend perspective. So even though the XLP led this week, is there anything impressive going on over here? Absolutely not. There's still an opportunity for a big monthly, weekly lower high. As long as we're underneath 71, this is going to be a really tough sort of climbing out of the hole, so to speak, for consumer staples. And even if it does rally, it's not really the right sector that we want to see propelling the market in the upward direction. So it's great, and don't get me wrong, upward pressure is upward pressure, but from a posture perspective, nothing really impressive going on here. Let's take a look at energy. Again, clear opportunity as a defensive play. If this stays up and over 89.25, I think that it continues to speak to a market in term oil, no pun intended, and that of course would be more of a volatile expression for our market, so to speak. Let's take a look at real estate. Again, flat on the lows, really nothing to write home about over here. It's a lightweight sector, but breaking to new lower lows is always substantial. It doesn't matter the weighting of the sector. So a new lower low underneath 32.75, that's a big deal for real estate. Let's take a look at the XLY, consumer discretionary. Again, Tesla earnings, really the nail in the coffin Wednesday after the close, breaking down from this balance. We already had issues with it. Remember that a lot of other sectors found double bottoms, they found inverted head and shoulders, and they broke over those necklines. The XLY never did. So this is not only a weekly lower high here, but breaking to a very substantial new lower low underneath a daily 200 SMA just offers an opportunity for, again, a back test and lower high underneath the now overhead supply at 156.75. So this to me is bearish no matter how you look at the chart. Sure, counter trend move might help intraday, but lower high here, just another nail in the coffin to continue the overall prevailing winds, which are down. Let's take a look at industrials sitting on the equal low, basically. Again, 8% of the S&P. It's not nothing. We're back inside of this as a choppy range. I'd be a little bit more neutral on this one. Again, breaking to a new lower low is always substantial, so we'll keep an eye on 98.25, but for the most part, kind of a moot point for the market, especially in the face of what's going on with the XLY. XLF also, again, this kind of diminishes the meaningfulness of the XLI, for example, but massive weekly lower high, even on decent bank earnings, right? A lot of banks reported that, hey, bond trading is quite profitable right now, obviously in the high rate environment, lending is kind of kicking off, and they're making more profits from those centers, but nonetheless, I mean, look at what's going on here. Equal low, weekly lower high, rejection of the major moving averages. I just don't see a world in which your S&P is going to have a substantial recovery when financials are performing like this. I mean, think about what was happening over here. This is the peak of the fear of the Silicon Valley Bank breakdown, right? And we're just breaking to, if we get a new lower low here, I think that it's kind of, again, suggesting that we might want to travel to these equal lows at 31, just furthering pressure across the broad market. So not out of the woods here, and clearly just an opportunity for another lower high underneath 33. That's kind of where we broke down from. If you wanted to consider this sort of consolidation, just loosely looking at the pattern, right? If that was going to be inverted head and shoulders, your right shoulder failed, and underneath 33, just a lower high, right? So not really constructive for the broad market there. Here's the XLB breaking to a new lower low, really lightweight sector. So again, it's meaningful because it did produce the new lower low. That, of course, is a bearish headwind. I wouldn't really write home about it, even if it tries for a counter trend. If it accepts back in here, not really all that meaningful. Let's take a look at the XLK. Definitely more meaningful, the heaviest weight risk on sector for our market, like the XLY, where we're not just describing how, a lot of other sectors did break out. There it is in your XLK. Notice where we're at. We're right at the origin of the breakout, 100% retracement, very similar to the QQQ. Nobody should really be surprised at that, of course. Again, if this is going to hold as a look below and fail, you need to turn around instantly early on in the week and hold 163.50. If we're underneath that, kind of kiss it goodbye. I would not be looking at the tech sector as a major piece of supporting evidence for the bull case if we're trading sub 163.50. All right, anything underneath that, I would target the equal lows. We're talking about 161, and then really it's the thin structural retracement from the AI mania breakout. You're talking about 157.75 daily 200 SMA coming into view. So I'm not really seeing the bullish argument here unless there's immediately a turnaround. And then you need to not only immediately turn around, but you need to not fail a lower high at 166.50. I can't really see it here out of the XLK quite yet. Let's take a look at the XLU for utilities. lighter weight risk off style sector. Rolling over, not the end of the world here. Nothing to write home about. I would say utilities are a moot point here. If it starts outperforming as the market tries to hold on, that would become a little bit of an issue, but right now, not really a big deal. XLV for the healthcare sector, D for defensive, but remember, second heaviest weighted sector by market cap, breaking down here underneath this low at 129, a little bit of a big deal. Definitely more bearish pressure for our market, and even though it looks like it's breaking down, as we'll see on the ratio grid in just a moment, it's technically outperforming on a percentage basis. That would speak to risk off here in the XLV, not making it to the equal low, not threatening a lower low, right? So for now, kind of, second heaviest weighted sector keeps you a bit neutral, but remembering its posture, it is D for defensive. So keep that in your back pocket. Here's the XLC for communications. And again, this speaks to the failed breakout, right? If this is going to turn into a double top, we started to break down through that neckline on Friday, through the 50 SMA, through just the structural level at 66.75, a rotation after a look above and fail, which is the major pattern, would suggest the bottom of the range is in play at 64.25. Certainly looks like a bearish headwind to me for our broad market, not some sort of bullish, big reversal indication. Let's take a look at the SMH and see what's going on with semis over here. And semis also stack up as a bearish data point, even worse than the XLK. Notice that if this is the range, Friday technically broke down. We did not even attempt any sort of higher low of the neckline, if you wanted to consider this, kind of like inverted head and shoulder. No reattempt here, right? As a matter of fact, breakdown through lower high underneath, and now under the major level of the overhead supply. So you're talking about a fairly substantial break. There's your AI Mania break. If we move lower, you're talking about 134. So again, another headwind here as we look further into something even like the semis. So let's take a look at the ratio grid. And if you're not familiar with this screen, here's a video tutorial in the top right-hand corner on how to set this one up. Overall, this speaks to a market that's moving away from turmoil to just straight up underperformance, right? If you look at the XLK, it's the only thing that's holding in there sideways as a heavier weight risk on indication. So great. But take a look at financials. Terrible. Take a look at the XLY after Tesla earnings. Terrible. Healthcare, which is D for defensive, moving in the upward direction. That's a risk-off indication. Industrials, not really doing anything underneath a 50 SMA. Communications, the only thing holding on here. It's the closest tie to the XLK as we know, and we'll see how that goes. We have major earnings players reporting in this coming week's worth of trade. If it goes anything like Tesla, I would imagine that this ratio starts to take a bit more of a hit. This ratio starts to take a bit more of a hit. What's going on with defensives? Creeping higher. Now, don't get me wrong, it's still underneath a descending 50 SMA. It's not a full-blown risk off look yet, but it's certainly creeping in that direction. Same thing with utilities rebounding here after the nasty rout that we experienced in the past. Energy, remember, is more of that defensive play considering the global context. Let's take a look at some specialized ratios because these two start to give us a little bit of an insight. If you look at the XLK over the XLU, so classic risk on versus risk off, it's fading, right? And of course, that would just speak to a lack of risk appetite for your market. Remember that this is kind of skewed because of what was happening with utilities falling off of a cliff when bonds in the short term really picked up more of a attractive yield. So what we can do is just replace those utilities with something like the SHY. 1 to 3 year treasury is good. And if we apply that, this is moving in the downward direction. And you might just say, Matt, this is just a mirror image of what's going on with the market. And I would just counter you and say, not really. Take a look at what's happening here. Take a look at what's happening here. The market produces basically an equal low, and the SHY clearly produces, or this ratio of the SHY to XLK clearly suggests more of an appetite for risk for your market. So right now, we're not really seeing a divergence. If anything, maybe you're seeing a positive divergence with the ratio not all the way at the bottom, whereas the S&Ps are technically sitting at an equal low. And I think that in my eyes, this would speak to a quick sweep underneath. If this does not make a lower low, I think you want to be very mindful of that monthly support that we were talking about in today's analysis thus far. So this, if anything, is a little bit of a slept-on divergence. Keep a close eye on that one. For more of an apples-to-apples comparison, let's take a look at the XLY over the XLP. And this classically is just more so saying, hey, failed attempt for risk on, back to risk off if this moves through the bottom end of the box. So keeping a fairly close eye on that one. Let's take a look at the dollar, what's going on with the dollar. Here's the Dixie. And it continues to just get bullish acceptance above the top of this prior range, which once again furthers downward pressure for equities over here. And the relationship between what's been going on with gold as well and just metals in general is decoupled, if you will, from the classic relationship of dollar gold, because this is a flight to safety, right? As they're clearly diverging from one another in the classic relationship, this is flight to safety. And I think silver really speaks to the same thing as well, not producing any sort of structural lower high underneath a very well-defined breakdown point. So for now, this speaks more so to, okay, the participants in the market are less less certain of outcomes in equities. That's really what I would see here, and not so much, hey, the dollar is going to break and rip to the upside and cause this nasty flush over here. It's more so uncertainty is the relationship that I would peg to that. Let's take a look at the 10-year, because the 10-year did something historic and it hit 5%, right? We have not seen that. I think the numbers were going back to like 2007, 2006, something of that sorts. And from a technical perspective, remember, let's look at this technically first, and then we'll talk about the Fed. This is just a beautiful uptrend. I mean, talk about higher high, higher low, higher high, higher low, so on and so forth. You're just continuing in the upward direction. We just produced a brand new higher high. So even if we pull back here, you're not out of the woods. You're still in an uptrend. You can find a higher low and you can continue in the upward direction. Not for nothing, let's go out to a maxed out chart here. Let's can we go max available, and let's change this maybe to like a monthly. Just want to show you that you have prior resistance happening here. Again, technical perspective only at 5.3 in the 10-year. So once again, the suggestion is that don't expect lower rates anytime soon. And that's a pretty, I think, transparent read of not only the chart, but also what the Fed is saying. Let's take a look at the inverted ZT briefly before moving over to the tracker tool. And what you'll see here is we broke to a new higher high, and now we're starting to pull back slightly. So still of the assumption that the Fed is going to, quote, pause and let the bond market do the work for them. But let's take a look at the tracker and just confirm that. No discrepancies here. Still seeing the prolonged pause from the tracker tool with 99.9% odds for a pause in the November 1st meeting, which is going to be here before you know it. But even better than that, let's take a look at the January timeframe odds, total probabilities. What we'll remember is that prior to Jerome Powell speaking on Thursday is that we had 50-50 odds of hike versus no hike. And clearly now the market's pricing in no hike. And that's on the heels of Powell's comments saying, hey, inflation, the battle against inflation is mostly dealt with. He spoke about how the supply shocks are mostly dealt with, how the labor market is coming back into better balance. And he also said, hey, the longer end of the bond curve is kind of doing our job for us right now with those yields moving in the upward direction. So nothing to really do. We'll just kind of sit tight and see if the lag impacts continue to work from a monetary policy perspective. What else is going on here? Let's take a look at what's upcoming, because it's not going to be an easy week this week either. First of all, Powell at 4:35 after the close on Wednesday, and PCE on Friday, 8:30 before the open. We'll be live together in the penthouse suite. Come hang out with us. Free coffee and donuts on us. So that's going to be a big deal. What is going on with inflation? You can notice over here, 0.3% is the forecast from a 0.1. That's not really the direction that we want to move, and it's pretty counter to what Jerome Powell was speaking about in his press conference on Thursday of last week. As a matter of fact, I'm not a full believer. I didn't have full confidence in some of the things that he was saying. I thought he was talking a little bit sideways there, but nonetheless, that's for the market to decide and me to interpret. Let's take a look at what's going on from an earnings perspective, because to me, this is fairly terrifying. Take a look at these two paragraphs right here. NVIDIA, if they're excluded from the information technology sector, or just think about it like this, if they post a larger than expected loss of earnings, or just a decline if they miss, look at what's going on here. A decline of negative 2.9% instead of earnings growth of 4.8% positive. That's one company in the S&P. And granted, it's much further down the line. We're talking about November 1st, but huge expectations for NVIDIA earnings this season. And again, if it's excluded for the entire S&P, we're talking about negative 1.8 from a negative 0.4. Look at how much pull NVIDIA has for your S&P. For anybody who is not a believer in like, okay, sure, it's cap weighted, but it is what it is. It still represents a broad base of the market. Not so much. And this is clear evidence of that. Let's take a look at some other earnings insights. I just changed tabs. It's still the same document. Looking at the scorecard here, not looking so hot. So far, earnings are coming in underneath the estimate, or I should say the beats are below the 5-year average. You can see 73% is what we have so far in hand. That's below the 1-year average, the 5-year average, and the 10-year average over here. Surprise percentage is also below our 5-year average. Remember that it's not always about just beating or not beating. It's how much did we beat or how much did we underperform. And so far, the surprise percentage is not looking fantastic. The last thing I want to point out from an earnings perspective is, if you remember when we had the interns do the math of the updated SEP statement or summary of economic projections, we talked about 4,200 in the S&P. Look at what's going on here with your EPS estimates at 240 still, roughly. But if we scroll down, look at what's happened with your PE ratio. We talked about taking the half of this move from here to here, basically. And that's exactly where we find ourselves at 17.5. Do the math, 17.5 times 240 up above your EPS brings you to 4,200 in the S&P. So far, that has played out quite nicely. We will see how earnings continue to affect the forward-looking EPS per share. It's redundant, but you get the point. EPS over here. Here's the calendar for the coming weeks worth of trade. Totally loaded week. We have Microsoft, we have Google. Visa is a massive contender for the financial sector, right? Meta, IBM is reporting as well. Amazon, just loaded week here. The only thing that we're missing is basically Apple and NVIDIA at this point in time after this week closes out. So keep your wits about you. It's not going to be an easy week from this perspective. A lot of these earnings, in my eyes, will determine whether or not the S&P holds its monthly area of potential support we were talking about around that 416.75. Let's jump back on over to the platform now that we have all of that out of the way and take a look at some risk appetite. Here's the TLT ratio to your S&P. Notice still underneath our resistance trend line. So classically, again, this would say, hey, risk appetite's fine in the markets, but let's take a step one step further. Let's take it one step further and have a look at bonds in relationship to one another. And what you'll notice is that they're clearly upticking here, here, and here. And that's exactly what we were talking about with the bond market doing Jerome Powell's job, basically, on the longer end of the curve. This would speak to a lack of risk appetite for equities when you can clearly see the preference is for shorter dated bonds, which are offering very attractive yields at this point in time. Let's take a look at credit spreads because this also directly speaks to what's going on in the TLT and just the flight to safety trade in bonds. Credit spreads are widening. This is not what you want to see. This is a risk off indication that we're seeing out of spreads, not only on the short end of the curve now, but also the longer to medium end. Look at IEF over LQD. We're talking about 3 to 7s in that particular instance, right? So no good from a credit spread perspective. If you tuned into the Wednesday update, you know that we had a staggering divergence from the HYG junk bonds and equities into the end of the week, and lo and behold, that played out beautifully. So if you make it to this point in the videos, then you're basically getting all of the major data points that support more of the bullish or bearish edge. And as of right now, you can clearly see HYG is trading on a lower low, lower high on Friday underneath. It's definitely more of the bearish edge, right? So this is kind of that supporting evidence that gives you the confidence intraday to say, sure, I have the faith to ultimately take this short, or I don't have the faith to take the short. Here's Bitcoin, the crazy store of value through it all, moving back up towards the top of the range. I'm going to start classifying this as more of a range instead of the head and shoulders that we were calling everything in the market. Regan, shout out to Mr. Regan in the chat. But anyways, there's Bitcoin holding up just fine. Again, store of value. If it breaks out over 3,100, I have to imagine from a technical perspective, you at least bring in some short-term momentum buyers. So keeping a very close eye on 3,100. And ironically, that kind of speaks to, risk appetite overall for the financial system. I mean, if you have money to throw at Bitcoin, then what does that say about people's financial situation, right? So just something to sort of sit on there. Let's take a look at some market breadth. What's going on with new highs versus lows? Made a substantial new lower low here. So that, of course, is a bearish indication, giving you the confidence once again on the bear side of the market. Here's the SPX A200R. This is starting to extend lower into the oversold territory. Notice that most times it needs to go deeper than just touching the top. A couple of instances here was fairly shallow. Those just hardly scratch at the surface, but oftentimes you're really looking for a read closer to 20% before you get that oversold reaction back in the upward direction. So keeping an eye on it, but once again, it would suggest that maybe there's one more capitulation flush in the market, gets us here, then looking for a stronger snapback. That would really be more constructive for this market in my eyes, holding that monthly S&P support. The other thing to point out here is that this is a little bit of a positive divergence. If anything, again, we're always looking objectively. This is a positive divergence. Notice that we're sitting on equal lows in the S&P, whereas the SPX A50R, stocks trading above their 50 SMA in the S&P, is trying to set a higher low here. Right? If this holds for a higher low, what would that speak to for the odds of a new money short being attractive here? Not really that good. So once again, is this possible that you could see an extension here? This remains divergent with a higher low, snaps back higher for a higher high, probably speaks to this trying to at least hold on the first attempt. So stacking all of the data points, let's continue here. What do we see with the RSP equal weight? This is definitely a bit more of a bearish data point, would suggest that, hey, maybe we're not going to hold on to it, right? If you think of this as an overall range, clearly broken down, clearly an opportunity for a lower high underneath 140. The only saving grace here would be, hey, can we hold on to support at 136? If we hold 136, maybe that would be the equivalent of looking for your higher low around this area on the monthly time frame chart. So trying to balance all of these things, you can see it's not so clear anymore on the short side when we start stacking the additional evidence. Let's take a look, before we get to the Dow, let's go QQQE. That way we can see the NASDAQ equal weight, right? And down here, I suppose we'll go NDX. And what we'll notice is that on the NDX, let's clear that one up, we certainly have a equal/higher low, whereas in the QQQ weighted, or equal weight, I should say, you actually produced a lower low. So continuing to just, again, walk through all of these equivalencies, this, of course, stacks up as a bearish data point. So you're getting all these mixed signals. I think that the price action in the S&P in its relationship to the QQQ will be a little bit more insightful. But for now, keeping an open mind. Again, it's all out bearish right now. I think that everybody changed the script on the Thursday, Friday breakdown. Is just going to rush into the market saying, okay, we're going to short it into the ground. Not so fast. Some of these other indications that we're seeing might suggest that higher low we were just discussing on the monthly time frame chart. Here's the Dow. This broke down in transports underneath this key support, suggesting once again a headwind for industrials to make the full rotation down into 31,750. A little bit more of a bearish data point over here. Let's take a look at the VIX. VIX is interesting because what this starts to suggest is that we are coming into some sort of capitulation style move with the break up and over 2050 on Friday. Notice that we closed up here towards those highs, right? So sure, there was a pullback intraday, but we've broken out and closed over 2050. That really is unsettling for what's going on down here in the S&Ps. When people are not certain of the future, right, what do they typically do? Change to defensives, it leads to some sort of selling. Let's take a look at the VVIX volatility of the volatility index. And what you'll notice is that we are far above the 103. This is the sort of inflection point that lights things on fire, so to speak. It's the precursor, if you will. And this now has two, what would you say? 1, 2, 3, 4 closes over the 103. Things get real nasty up and over 120, and we can confirm this with our volatility futures. If you look at the /VX in relationship to the front and back month contracts, we're over the zero line, indicating backwardation. Really not what you want to see if you're a money manager. You do not want to allocate capital in a risky environment when you can see in the future there's less volatility priced in. So overall, that would be a headwind for the market. One-day VIX still extremely elevated in this as a micro range. The only thing on the screen that's slightly like, okay, maybe that's all right, is that, 9 versus 30-day VIX, it's underneath the zero line. It's not technically in backwardation there, but it's still very tight. It's certainly not anywhere close to the lows that are much more comfortable. If you've made it to this point in the show, let me know if you're watching on the Saturday night midnight release or early morning Sunday with coffee and charts. Nonetheless, Apple is up first for our core list of companies. Here is the balance range that we're really looking for a higher low to be set around. The 174 level, clearly closing underneath, puts the bears in the driver's seat with an opportunity for a lower high, not only underneath that level, but still a daily lower high could be produced to continue this very short-term downtrend underneath 175.50. Also, is there an opportunity for a daily higher low still somewhere in this zone? Absolutely, but where? Not so clear, considering that this was really just a balance range. You do have 170.50, but getting back down to that, really not ideal. Still, yes, technically a higher low, maybe daily 200 SMA provides a little bit of confluence, but keeping an open mind in this range for lack of clarity in terms of price action basically out of Apple. Here it is on the hourly chart to make a little bit more sense of why I was saying 175.50 is such a strong level for a retest, right? It's just the retest of your overhead supply now. So certainly the opportunity for a lower high. Against that, 174 was actually producing an intraday lower high on the Friday session, not at all a bullish indication. Let's take a look at Netflix. What's going on with Netflix? Gapping up on earnings, clearly just stuck sideways in the range. You have very clear outcomes, over 405.50 or under 399. If we're under 399, I'd still keep an open mind for a stronger weekly or even daily structural higher low around 387.75. If that doesn't hold, okay, different story. We'll reevaluate shorts, but for the most part, I think that all the shorts who are trapped from back down over here, they want an exit. And the first place to get out for break even for anybody who literally nailed the top here or got involved in this upper wick is at 387.75. If that really holds for a higher low, these shorts with even worse location are like, my goodness, I got to get out of here. You see that squeeze in the upward direction. If you get over 405.50 early in the week with tempo, basically meaning speed on the tape early on, you could see the squeeze into 419 sooner rather than later. Here's Tesla post earnings, really brutal. Let's take a look at the daily chart. I just want to reiterate that Tesla was actually a primary beneficiary of the AI mania rally, right? It's kind of a slept on name. It was all eyes on NVIDIA and the chips, right? But look at this level. If we start to fail this on Tesla, you're talking about a deeper retracement. I'm not arguing that this, comes and trades this week, but 160 is the bottom of this as a range, right? So really something to start thinking about. We are a bit extended after the earnings gap down, stacking on further losses Thursday and Friday, tangled up with the daily 200 SMA. Technically, we did close underneath. Wouldn't be chasing new money shorts, instead looking for a lower high to be set reset anywhere underneath the earnings gap. So 230.65 is that threshold. If we do just continue, obviously have 204 and 192, but again, difficult from a location perspective, initiating a new money short after the damage has been done. Longs, if you're trading for a counter trend move, here's the hourly, right? You want to see a higher low over to 1850. Let's continue along. Let's take a look at Google on the daily time frame chart. We're just going to do a high level overview here because earnings are this week. Remember, you want to avoid getting into names with implied volatility on the uptick. As soon as earnings get released, implied volatility gets sucked out. Your options premiums suffer dramatically. So on the daily chart, I think there's an opportunity for a higher low around the 50 SMA. I would really just be paying attention to 134.25 early on in the week. If we can hold that, maybe counter trend moves in the upward direction, you will have to contend with the retest of 136.75. Here it is on the hourly, just to maybe make a little bit more sense of that. There's the overhead range. You know, the better constructive daily higher low here, again, keep in mind earnings, but this constructive look would be something that does this. You guys know my favorite pattern at this point in time, inverted head and shoulders back over the bottom of the overhead supply, 136.75. That's a stronger daily higher low. Again, you have to contend with this, but that would be the ideal pattern out of Google. Here's Meta. What's going on with Zuckerberg's fantasy land? Let's take a look at the daily chart. A little bit of a deeper retracement underneath the prior structural highs that we ideally wanted to hold for a break and retest. Still an opportunity, again, for a higher low. We're not discounting that. We do have earnings on Meta as well. They're Thursday after the close. You got to hold 306. If we're underneath 306, I think that you're just back in the midpoint of this range, and it's choppy. I would not be interested at all if Meta is trading underneath 306. Really, in this range, I'm starting to lose interest. It's got to recapture 310.75 quite rapidly for me to maintain interest. Otherwise, in here, we all know the story of Meta. It was just an awful trader. It did not respect any technical levels, volatile whipsaws up and down. Be my guest if you want to trade it, but it's a back burner idea for me. Let's take a look at NVIDIA. We talked about the importance of their earnings much further out late on in November, so not a concern just yet. Everybody and their brother's sister's mother is talking about the head and shoulders. So is it going to break and fail? I think that you have to wait for it to break and then fail because it's such an obvious pattern, right? If everybody's arguing that, okay, this thing's going to send it to zero, then you've got to break and confirm it, right? If you don't confirm, if everybody gets suckered in and then we start trading over that neckline, that's where the danger is for a squeeze back in the upward direction because everybody's short and now the pattern has failed. So you need to watch it break first, and then if it's going to fail, that's where the long is, right? So I would not be a buyer just yet on the 100% retracement. I would be more so interested in seeing what the reactions are around 400. Let's take a look at the hourly time frame chart. You can clearly see the price acceptance on Friday is underneath the 2-day range overhead. So for now, it's bearish until proven otherwise. If the 2-day range is going to break and truly cause the measured move to hit, you would be thinking about a doubling of that range closer towards, what is that, like 406.50s, right? So still some downside room in NVIDIA. You'd probably look for an intraday lower high beneath 412.25 to actually participate in that style move. If you find yourself with a higher low over 418.85, maybe, just maybe, you have look below and fail, right? And you trade bullish, and that probably is enough to try to keep your S&P sideways at the monthly higher low area, right? So watching NVIDIA closely, I would say 418.85 is perhaps the most important pivot. If we're above, a little bit more bullish for the market. If we're below, you know the deal. Let's take a look at Microsoft. This is reporting earnings as well earlier on in the week. I think it's on Tuesday after the close. Looks about right. So for now, early in the week, like I would say Monday only, you could trade this for lower highs continuing underneath 328.25 or a higher low above to produce an intraday like 15-minute double bottom. Higher low here confirms the neckline. Just rotate back up to the top of the range at 332.75. So everything early in the week depends on this level right here. After earnings come out, it's anybody's guess. So we'll leave it off at that. 328.25 is the pivot out of Softy. Last but certainly not least, we have Amazon, the mini beast. What's going on with Nancy? You can see that she is back down in the range with a lower high underneath the midpoint, 126.50. Earnings later in the week, Thursday after the close. I think Meta might have actually been on Wednesday after the close. Regardless, you can rewind, look at the earnings calendar. For now, bearish acceptance, right? I would not be trading bullish out of Amazon with a gift. Again, think about the gift here. After the breakdown, to open back over the 129 top of this range, buyers really had an opportunity to prove it and say, okay, we trapped some sellers, time to rock and roll in the upward direction. Simply did not happen. It was a straight shot lower, no support intraday at 129. I think the bears are clearly flexing the muscle here and saying, hey, we're in the driver's seat. Right into earnings, we are in the driver's seat. So lower highs down here, the ultimate bear flag consolidation, looking for lower. Any rallies, lower high reattempts are certainly possible underneath 129. Final trade idea is on Roblox. Ticker RBLX is what we're looking at here. And just look at the astonishing relative strength on the Thursday and Friday sessions. I mean, look at what we have going on here. The broad market is basically in free fall on Thursday and Friday. Even the volatility from JPOW on Thursday, right? It's just green, straight in the upward direction out of Roblox. And Friday produces an inside bar in the upper 50%, meaning that we have a very classic 3-bar play on our hands in the upward direction. The icing on the cake is that we have a large overhead gap range to be trading for. Over 32.50 closes at 36.60. You could start to also look at this through the lens of really sloppy cup and handle. You could look at this as a break, retest, and higher low from a lower low double bottom, which remember is pretty powerful. Everybody gets this one a little bit mixed up, right? The lower low represents that we're in a downtrend. The fact that we go from a lower low to a higher high wipes out a lot of the sellers. Now we have a higher low above that particular instance. To me, there's a lot of relative strength here, and there's thin structure overhead for this gap. Now, the range is not, it's nothing to write home about. Roblox is a $30-ish stock. You could either trade it outright or go to the options chain and look for something that fits your either budget or just the amount that you can actually take without causing liquidity issues. But nonetheless, this looks like an attractive setup to me if the S&P is going to hold for a monthly higher low. If the market is in free fall, I would have less confidence in this setup, and I would really just focus on, once again, the S&Ps and the NASDAQ. That's going to do it for today's episode of the Weekly Watchlist. Once again, let me know if you're watching on a midnight special or with your coffee and tea on a Sunday morning. Regardless, I hope to see you in the pre-market prep, which is on Monday, every day really, at 8:15 here on the channel. And with that said, I wish you a green trading week.